Hello, everyone. Hope you can see me. And today it is 21st day of June 2026. This is our first lesson of so many lessons that are coming on this channel. I welcome you to Driips Trades. Basically, Driips we are ICT trading traders. So basically, we trade ICT concept or smart money concepts. But the difference that we bring to you, as you will see, we really codify every concept that is going to be taught on this channel and in many of our channels. Even on our website, you'll be following us. So I welcome you to our first lesson. Our first lesson is inspired by time itself, because with ICT, we believe that at the right time, price will move into a certain direction, or it will not move. But time has to arrive before the market moves. And also, this framework is used and applied to indices. So if you're a forex trader, this is not specifically to you. And the times we're going to use in this study, throughout our studies, the time is New York time. So when I say 9:30, that is New York time. It doesn't matter where you're watching us from in the world. We are not talking about your time. We are referring to New York local time, whenever you are. Okay, today we want to introduce block 1 of 5 blocks that we will be discussing our 9:30 open framework. This block 1, which is taught in this lesson specifically, it introduces the very first component of our framework. Liquidity, we believe the core idea of this framework, we say liquidity will happen first, then manipulation, and what will follow is delivery. This is exactly. So we need to first understand what is liquidity. Liquidity we believe that at 9:30, when that time comes, price is no longer random. It will seek liquidity. But what is liquidity actually means? Liquidity is resting orders, mostly stop losses, sitting just below obvious highs and above, sitting beyond highs or lows. Basically, in terms of lows, we are referring to orders sitting or stop losses that will be sitting slightly lower lows, obvious lows. And then the opposite talks about slightly above highs. Big players need those orders to be filled to fill their orders. So when we talk about big players, as we move on, I'll introduce things like market maker models. So the market makers, they're the big players in the market and other serious commercial traders. Me and you are not. We are retail traders, but we need to align ourselves. The ICT philosophy, it emphasizes us aligning ourselves with the big boys in the market. So price is drawn towards them like a magnet, those orders slightly beyond, as you will see. Now that becomes liquidity. Your job, mark the pulls before 9:30. So you already know where price wants to go. Buy side liquidity stops resting above. Sell side liquidity, we are referring to, stops resting below previous lows. Prices reaches down to grab them. So when we talk about liquidity grabs and things like that, this is what we'll be referring to. Your draw on liquidity has to be mapped before 9:30. We're going to have, you can see, let me hope you can see this, buy side liquidity, previous highs, and then sell side liquidity, previous lows. Okay. This one, for example, this is happening below, then we're going to have what we call a dealing range. A dealing range will be defined looking at what the most significant or the most obvious price range that we can see. We can use it, or we can use it as we will see in this model when we are applying it in real markets. So we want to, this model, you may ask what time frames. We're going to limit ourselves between 15, 5 and 1 minute time frames. We're going to start everything at 15 minutes time frame. So this is an intraday model. To see the obvious pose, draw, then we're going to drop to 5 minutes. Then our entries are going to happen mainly on 1 minute to sharpen the exact levels. We want to go to 1 minute. Watch for equal highs and lows. Engineered liquidity, that is extra magnet. Basically, what are equal lows? We're going to find ourselves where price is moving almost, where it moved as if there some close prices. What qualifies to be called equal highs? For example, you can see here, price, we can consider this. I don't know if I can see my charts. Yes, you can see charts. I can see that you can see them. These can be considered equal this area. These ones can be considered equal highs, but they were taken out, as we'll see later. Why? These can be considered equal lows. That is a big pool of liquidity. The market will have interest there to move. The big boys, they would like to come here. They would like to come above here, take out. So when they move above here, came back and then returned back, this qualifies to be called what? This is qualified to be called a manipulation. You notice when we went there, then we started moving at high speed. Okay, we can look at this one and these ones. Here there was something equal, relatively equal highs. We took them out and then we started later to move out. You can pay attention to the same things. So here we took out these relative equal lows and then we started moving and so on and so forth. Okay, those can be considered equal highs and equal lows. So the time frame is clear. Another thing, not all liquidity is equal. All the highs and lows. This is the baseline pole. A single obvious swing point, a single relevant swing is reliable, but everyone sees it. So it has to be all the highs. It can be weekly, previous week, previous day, previous month, previous quarter. It has to be very, very clear to everybody. Then, what we refer to as equal highs or lows, we are referring to equal 2+ touches at the same level. You note that the price will be retesting that area. They can be 3, 4, 5 times, but it had to be more than 1. 2+, okay? 2 or more. Stop stuck at that level. A richer, more magnet pole compared to the old high or low. This one becomes very magnetic. Basically, it's where the market wants to go because there is a lot of activity. Equal highs and lows signifies that there was a lot of activity that went on to that level. The draw on liquidity. The high time frame objective price is delivering towards. Basically, This can be used as your target. You're going to go, let's say, to daily candle to target monthly targets. You're going to go to an hourly to target the daily range. Basically, that becomes your draw on liquidity. But where your draw on liquidity is likely to go is going to be influenced by your higher time frame levels. That's why for this model, what is our time frame bias used for? We anchor this from COT data and also 4-hour reads. Okay, COT is data that is released every week, every Tuesday. This is a United States data that is released. This one is the only fundamental thing that we use in this model. Block 1, your pre 9:30 ritual. What do you do before 9:30? You're going to mark buy side liquidity or previous highs and sells side liquidity, previous lows and previous highs. Mark them. Don't be by the if normally one of the things, as you see in our playbook, the playbook, I think if by 9:25 you haven't marked everything, please do not trade that day. Forget about it. Don't come when you're disorganized. Refine 15 to 5 to 4 in that order. Don't start from 1 and then go back to 5. No. For example, you can have your fair value gaps marked on 15. Let's say also your dealing range can be defined by 15 minute time frame. Then you come to 5 to start seeing things like confirmations, like a change in state of delivery, things like that, order blocks. Okay, and then for 1 minute you come to find those refined fair value gap. Like for this model, we also ask it something like first presented fair value gap. It's one of the things we ask this model to give us. It will increase the probability of the outcome. So we need to flag equal highs and lows. This is the richest form of pull. Like I have said, equal highs and lows, they're telling us something, that here there was a lot of activities. That means the activities that took there were orders there. They're still orders. They're used as a stop loss, because many school of thoughts or philosophies of trading, they will look at those things as points of resistance and we want to hunt those ones. We also have to note higher time frame draw on liquidity. One of the techniques I'll show you later is use of standard deviation predictions, okay, or using manipulation leg predictions. What do you need to avoid? Trading before the pulls are marked. Don't come to guess. If you have not marked your pulls, do not trade. Marking only one side, then you're losing the entire picture. You need to see both sides, the buy side and the sell side. That will help you to locate where are you located. Indirectly, you're marking your dealing range. We sell when it comes to dealing range. We want to sell when we are below the equilibrium, and we want to buy below equilibrium and we sell above equilibrium. Treating every high and low as equal, they aren't. When you find one odd sharp high or low, it's not the same as equal highs. But at the same time, they're going, even when you're using your targets, this is the same kind of thinking. Draw on liquidity is technically the liquidity you're targeting, basically. Where is liquidity likely to be drawn that day, that month, that hour? Basically, that is what we're looking at. Ignoring the high time frame draw. If this model reduces its probability, for example, if you're trading against COT data, or you're trading against the 4-hour, the 4-hour what? The 4-hour bias. That if you're ignoring it, you're likely to have a bad trade. So block 2 will be next. Now allow me to go to charts. I've put my chart on 15 minutes because that is where I want to start from. This day, it is Friday 12th, 2026 June. The market comes, opens, and goes down. On that day, before you traded, these are relatively equal highs. You have to mark these ones. That was very obvious, equal highs. Okay. Those. I'll also mark this single low because it opens when you're here. If this day the COT data and 4-hour levels information was telling us that we're going down. Why should we believe it? This is a single what? A single high. These are double highs. Okay, this can be treated as our old low. Once we took this out and it started closing, you see when this kind of formed, this one is confirmed as manipulation. This one has been manipulated. This entire move, the first 15 minutes to let's say 20, they were manipulating. Okay. Also something that we'll be considering looking at is now going at 5 minutes at that time. When the market opens, I encourage you to also move straight. At open, you can start watching the market from as low as 1 minute candle. I'm unable to spot. Okay, you can use this 5 minutes. No, it was 12th. The example was on. It was 12th. So it has to be this. This is what I have taken out. Now, at this point, when this guy was moving, your attention is already here. Once they take that out, now on 5 minutes, one of the things you will do is actually to mark the last black candle, the manipulation leg. This one becomes a manipulation leg. Then you see this one becomes now the new target. Okay, once this one is engaged, you want to look at the opposite side. And it's true, this day the market delivered at least up there, up to these highs, these equal highs. Okay, it took some time, but it eventually went exactly there. Exactly. This is what I'll do. I'll measure that. I'll explain how we use this tool now, but not in this. It's out of scope of this lesson. So basically we went late and evening. This is the point where you had to realize where to go. One of the things you can do now on that same day, let's say after 15 minutes, or let's say the first 5 minutes, you're going to watch them that way, and you eventually go to 1 minute. Here you come. Now on 1 minute, one of the things you notice that if you used 1 minute, you have more information. You have quicker to find the entry points. Okay. Now with 1 minute, yes, that fits my target. Normally my target is 2 to 2.5. That's the first leg, and then the second leg should go to 4. That delivered even before these equal highs. And yes, we almost made it to 4, slightly. So here, one of the things you have to look for is maybe this first presented favor gap. Forget about that because it forms at exactly 9:30. See, when they raided this, you could think that they are going back. They came back, they took out this, and what happens? Bang. Now we have more. We have relative equal highs here. They're also used as target, but also these ones and this one. These are also, like, we have engaged now more around this time. You see the way they came in, when they started coming in, like, it's like they did not exist. So basically, you marked your equal highs or the low, and then draw on liquidity. This is how you look. This one becomes your draw on liquidity. The moment they engage to this, that's what block 1 is explaining. Okay, we can do the same and watch the following day. Straight to the point. Don't be ambiguous. I'll go back to 15 minutes. The same thing. This is example 2. I'll give only three examples. Then because this was a buy. Yeah, we can have just this one is a reversal example. This one is a reversal example. You can say this one was also a reversal example. But I want to use also this model. Captures both continuation and the reverse trades. Now, this was our equal lows for open. We also had that. But before this open came in, we had taken out previous day high, which fits our narrative of 4 hour. So you've taken out this previous day high, and you had started moving in down already by the time you opened. On such a day, we had manipulation had already happened before 9:30. That's why we call these ones, we call it a continuation entry. Then you can mark these fair value gaps. You can see this is lovely delivery. You had that at open. What happened? They just came back into that, respected that, and then started moving out. So this was one of the examples you see as a continuation entry because you had already cleared liquidity above here. Okay, and also this liquidity or pre-market, more or less, yeah, it had already been cleared. Then you started moving down. On this day, same narrative can be watched, like can be used as a conclusion. Now, when you go back into, let's go to 5 minutes in this day as part of our examples. See what we see? There's another form of liquidity that is taken out here. So when we talk about liquidity, one of the things we will see, our liquidity can also be in form of fair value gaps that are there. The market will move back there to do what? To provide fair value. And also this kind of run back here, it was not sufficient for us. Since these ones are relatively equal loss, this one is invalid. I don't take it as something as a rate, okay? But I'll take this one more as a rate than this. So when they were going back, what you do, you have to measure that new range. Look at the magic. This is where they went above that midpoint of that range. Dealing range is one of the tools that we'll be using for this model to find our entries, and it meets this plus this, because I'm seeing a lot of things here. This is a breaker, fair value gap. Actually, that entry is what we refer to as a unicorn model entry. Now, that unicorn model entry happened at a right time. Okay, you can search for first presented fair value gap. Either we use this on 15 minutes. It came in even during the first or macro. Okay, we're going to use macro and things like that. So on this day, what happened? It came back, it traced back. Also the retracements give us the continuation. Now, if I want to go to 1 minute, I don't remember the date. I think was okay, this is the date. 1 minute. Look what happens. Now, 1 minute is telling me they accumulated into the fair value gap. Which fair value gap? 15 minutes fair value gap. Let me then highlight that. Okay, it is a 15 minutes fair value gap. They are respecting consequence encroachment. So what you're seeing is weakness. Okay. Now, one of the things you could do is to locate first presented fair value gap up to here. Maybe I can use that. You see this candle as a first presented fair value gap, or I can use this because these are the most prominent ones. Or yes, because here there is nothing, but here what I'm saying is the change in state of delivery is one of the things we'll discuss. When do we confirm the reversal? So that is a continuation compared to that big range. Okay, this, we are trading above equilibrium of that range that is formed. Another example that is a continuation. I've given you the continuation entry. I gave you a reversal entry. This one also can be grouped as a continuation entry, or slightly reversal. It is a mixture of a lot of things. Okay, it's not very clear. You can see even this can be considered also a reverse. We do not, but around this time you will notice that one of the things I will be emphasizing is SMT to happen, but SMT is out of scope of this block 1 lecture. So with that, see you in the next lesson when we are talking of block 2. Block 2, what to expect basically